This is a Your Stock Our Take from James, who is one of our VIP clients. And he says, you may have already screened or filtered this company, Simply Better Brands Corp. Latest earnings were US about 5 cents per share with shelf space at Walmart and Costco. If not already on your radar, would you investigate and or possibly consider a candidate on Your Stock Our Take YouTube presentation? So, of course, I can do that for you here, James. Simply Better Brands Corp, SBBC on the TSX Venture, currently trading at a price of about $1.03 and has a market cap of about $92 million. Now, the company is a consumer products company with emerging plant-based and holistic wellness products. The company has an asset-light model using co-manufacturers, and its products include plant-based True Bar protein bars, skincare products to consumers through its No BS brand, as well as hemp-derived products, including CBD under the brands of Seventh Sense and Vibes. And if we look at the most recent quarter, about 95% of revenue was from the protein bars. So, as Ryan said, this is a company that we are familiar with, as I interviewed the previous CEO, Kathy Casey, back in September 2023 in Vancouver. And when I spoke with Kathy, she gave me the rundown that they went public in December of 2020. They had done about 5 acquisitions over that period. And the ethos of the company, she said, is to bring in Shark Tank kind of brands where they may actually build them and sell them off. So she was kind of like, talking about being like an accelerator for these businesses, essentially. You may have heard that term before. However, management hasn't executed exactly to plan, as we have seen a few of the businesses, subsidiaries struggle, leading the company to restructure and dissolve Herb Edibles, as well as Pure Canna in 2024, as the latter filed for bankruptcy, actually. But, generally you can see here, the stock has had a positive year, despite the restructuring and really trying to get operations back on track. So looking at the restructuring here, we can see that operating expenses have been reduced, which is positive, and the company is focusing on its growthier assets, such as TrueBar. So you can see the ones that are crossed out there are the ones that they're basically dissolving. And for example, if we look at TrueBar, sales went from approximately 10 million in 2022 to 24.7 million in 2023, and they anticipate to be between 45 to 50 million in 2024. And they actually just increased that to that range this year. So again, good to see that the company is restructuring and focusing on core products, core growth products. But this shows how the company's past strategy and execution was weak. And the company is now up to 93 million shares outstanding, up from about 73 million shares for the same period last year, as they have lacked profitability. Now, looking at the recent quarter of Q3 of 2024, keep in mind all values are in US dollars here, and all the numbers I go over here are from continuing operations, so they do not include the disposed of assets. So revenue from continuing operations increased 124% to 12.1 million, driven by a 156% increase in TrueBar revenue. Gross profit was 5.5 million, or about 45% gross margin, compared to 2.2 million, or 41% gross margin for last year. And this was primarily driven, the increase here was primarily driven by lower production costs at TrueBar. Adjusted EBITDA was positive 1 million, up substantially from the same period last year because it was a very small number last year. And net income from continuing operations was a gain of 4.1 million, or 4 cents per share, compared to 400,000 or 1 cent per share for the same period last year. However, it is important to recognize that there was actually a gain of 4.18 million on remeasurement of warrant liabilities, which boosted profitability dramatically. So if we remove this, net income would actually be much closer to break even or in a slight net loss. So the profitability isn't actually as robust in Q3 of 2024 as on the surface. So you can see there. Now, the balance sheet is in a slight net debt position of about 800,000, and management just announced a new $10 million credit facility with BMO in December, which is intended to be used to support expansion of TrueBar sales. And the interest rate on the new facility will be Canada or US prime rate plus 3.5%. And quickly looking at the valuations, again, because there's no profitability here, we really can't look at earnings, EBITDA, or cash flow. So if we use the company's forward price to sales, the stock is trading at about 1.35 times. Now, looking to this year, fiscal year 2024, like I was just using for that forward sales valuation, the company is guiding towards about 45 to 50 million in TrueBar revenue, which will represent an increase of about 92% over fiscal year 2023. But I could not find any adjusted EBITDA targets like they had provided in the past. And if we look at 2023, the company was guiding towards 80 million in consolidated revenue, which it did achieve. And again, keep in mind, this was including disposed of assets now. But its adjusted EBITDA was actually a loss of 2.7 million rather than what they were guiding towards was a gain of 3 to 4 million in adjusted EBITDA. So keep that in mind. They have missed that in the past. And looking forward, we're somewhat in the dark on the profitability picture. So to conclude here on Simply Better Brands, the company has, relatively a spotted past of executing on accretive acquisitions and generating profitability, which led it to restructure in the beginning of 2024 and over 2024. Now, executionally, it is not a good look. But at least looking forward, the company is focusing on its growth products, and hopefully it can massage margins higher. But that we're still seeing the company lose money. The company's TrueBar protein bar makes up a majority of its sales and has shown strong growth, which is good. But it is a consumer product facing strong competition, so keep that in mind. Personally, I eat Cliff Bars for my protein bars. Not like any listener really cares, but that is one of their main competitors, and I do enjoy their protein bars. The balance sheet remains relatively healthy, but is in a slight net debt position now as the business generates minimal cash flow and EBITDA. And like I was saying, they have a $10 million credit facility that they may, but probably will tap into. And given the growth in TrueBar, it is intriguing and profitability may trend in the right direction following the restructuring. But this is the gamble an investor would be making if they wanted to invest in the company. It's too risky for us, too early. We'd really like to see, profitability, trend in the right direction. If that 4 cents earnings per share was actually 4 cents, it would look better. It would actually be, maybe an interesting breakout quarter in profitability. But at this point, it's just a monitor for us, given the lack of profitability and, spotted history of execution.
Yeah, and it does just look like, even in their corporate presentation, they have a slide that talks about the historic bar space M&A transactions, and they're comparing deal multiples to kind of where they are. And, it looks like that is the end game here. That's what they're looking to do. I think you're getting ahead of yourself. I think you should focus on growing the revenues, having profitability, having a business that people are bouncing, knocking at your door instead of going out there saying basically, at some point we're for sale. Focus on that, and then you get acquired. Perhaps that happens to this business. Perhaps the business gets acquired. But if that's your goal, I think your goal should be to grow profitably over time, and those things take care of themselves. Kind of is putting the cart before the horse in this case.
Agreed.
Horse
and
before the cart, it would be better.
And that's the thing. Like me and Brett were just talking earlier and like comparing our companies, and he was just like, "So how does Simply Better Brands look?" And I was like, not the best. Just in relation to profitability. And he was saying that Flow doesn't, screen that well either. Again, because of profitability. And what are both companies kind of like parroting? They're talking about trying to focus more on profitability. So it's just, again, like this is what will reward you in the market. We went through this crazy time of, from 2021 to maybe 2022, yeah, probably, where people were just slapping EBITDA multiples on and no one really cared about bottom line. And there were so many high flyers out there. You know, profitability and earnings growth drives share prices. These management teams understand that, but if they can get to profitability, we will see.